Silver at $74 is not the bottom, and it's not a gift. What it is a threshold, one that separates investors who understand structure from those who are still reacting to price. The drop from the highs was not chaotic. It was methodical. Retail positions unwound, headlines shifted, the narrative quietly changed from scarcity to oversupply, from momentum to fear. That shift didn't happen organically. Sentiment, this coordinated, rarely does. What you're watching is not a natural correction. It's a psychological operation designed to transfer conviction from weak hands to patient ones, and it is working exactly as intended. The emotional buyers who entered silver late, chasing the move, ignoring structure, are now sitting on losses and making decisions based on pain rather than analysis. That is precisely the condition in which real positioning happens, not by them. Against them, smart money does not buy into strength, it builds into exhaustion. Right now, exhaustion is visible in every volume indicator and every sentiment survey that crosses this market. So why does $74 feel significant? Because it sits at a convergence of historical support, prior consolidation, and a psychological level that serious buyers have circled for months. This is where dip buyers begin entering quietly, not with conviction, but with structure, scaled positions, defined risk. No fanfare, but here's what you need to hold alongside that. If $74 fails, not dips below, but structurally fails, the next logical destination is $55. That is not a prediction designed to alarm you. That is a cascade reading. Stop losses clustered below support, combined with dollar strength and any renewed liquidity pressure from rate dynamics, create the conditions for an accelerated move lower. The mechanism is simple. One layer of stops triggers the next. Panic selling amplifies what began as technical weakness, and within that cascade, $55 becomes not a floor, but a magnet. The trigger matters more than the target. Watch dollar momentum. Watch institutional credit conditions. If liquidity tightens again, and there are credible signals that it might, silver's industrial demand narrative will temporarily lose to pure financial pressure. It has happened before under similar structural conditions. Now the real question, buy at $74 or wait? Both answers are defensible. Entering here captures better price if the level holds, but exposes you to significant drawdown if the cascade scenario activates. Waiting is structurally safer, but carries its own risk. A sharp reversal from this zone could move fast, and the next visible entry will be at a meaningfully worse price. The answer is not a single entry point, it is a framework to split your exposure across four levels: $74, $68, $62, and $55. This approach removes the psychological burden of being right on timing, which nobody consistently is, and replaces it with a mechanical response to price behavior. If silver recovers from here, your first tranche captures the move. If it falls further, your remaining capital deploys at structurally stronger levels. The worst case scenario, a complete breakdown to $55, becomes your best average entry rather than your maximum loss. This is capital discipline applied to conviction, not speculation managed by hope. What matters now is not whether silver goes to $55 or reverses from $74. What matters is your positioning relative to either outcome. The investors who will look back at this period with clarity are not the ones who called the exact low. They are the ones who held a framework when everything around them was noise, and silver is not losing its structural case. Central banks are still accumulating. Industrial demand for energy transition is still embedded in long-term planning. The monetary system is still under the pressure that makes hard assets relevant. None of that has changed because price dropped. What this moment is testing is not your analysis. It is your patience. That is the real war. Not the price, not the level. The patience to act without panic in either direction, to buy without euphoria and hold without fear. This is where conviction is built or broken. Choose carefully. Silver at $74 is not a market event. It is a message. The question is whether you are reading it correctly. And when a market generates this much retail noise, everyone debating $55, everyone asking whether this is the top or the floor, that noise itself is the signal. Confused retail is useful retail. Confused retail sells early, buys late, and hands positions to whoever is patient enough to wait. This is not new. Silver has never been a clean market. The ratio between paper silver and physical silver in global trading is estimated in the hundreds to one, and that means the price you see on your screen is largely the price of a contract, not a commodity. Institutions don't need to manipulate sentiment manually when the structure itself produces exactly the behavior they need: volatility that punishes small positions and rewards large ones. At $74, two scenarios are active simultaneously, and pretending otherwise is a mistake. The first scenario is that this is a structural bottom, not a comfortable bottom, but the kind of uncomfortable, high-doubt floor that forms before real movement. Weak hands are being extracted. Every person who sells here at a loss is transferring their position to someone with a longer time horizon and deeper capital. That transfer does not happen at price levels where retail feels confident. The second scenario is that $74 is constructed support, a level held just long enough to look stable before the next leg down. Liquidity crunches do not respect narratives when large players need to raise cash quickly. Metals are among the first assets sold because they are liquid, globally traded, and not subject to the circuit breakers that protect equity markets. A move toward $55 in that environment would not require conspiracy. It would only require sequence, credit stress, forced selling, and a market with too much paper and too little physical demand to absorb it. Neither scenario cancels the other. Both can coexist as probabilities, which is precisely why positioning matters more than prediction. If silver reaches $55, the beneficiaries are not retail buyers who timed the dip correctly. The beneficiaries are institutions that already hold short positions at higher levels, hedge funds with the balance sheet to accumulate at distressed prices, and anyone who systematically destroys retail. Confidence in an asset class before re-entering it quietly, destroyed confidence, is valuable. It clears supply at favorable prices and removes the only participants who might hold long enough to complicate the next cycle. Smart capital at $74 does not go all in. That framing belongs to someone selling something. And what actually happens at this price level among those who have done this before is staged construction. Small allocations at current prices, reserve capital for lower entries, no leverage, no urgency, conviction built through structure, not emotion. The professional behavior in a market like this is counterintuitive. Buy when the narrative is worst, hold position sizing below what feels comfortable, and treat every piece of fear-driven content as an invitation to evaluate, not to act. What you avoid matters as much as what you do. Leveraged positions in a manipulated, paper-heavy market can be liquidated before the underlying thesis even proves correct. FOMO-driven entries at resistance create the exact emotional instability that leads to selling at support. The market does not need to beat your thesis. It only needs to beat your psychology. This is the point where silver stops being a commodity discussion and becomes something more foundational. The question is not whether silver goes to $55 or $100. The question is whether your decision-making process is structured for either outcome. That is what separates the people who are positioned from the people who are perpetually reacting. The system benefits from your reaction, and it is built around it. Every spike in retail uncertainty creates movement that institutions can use. Staying calibrated inside that environment, not paralyzed, not reckless, is not just a strategy, it is a discipline. Stay ready for both outcomes. So that readiness is the position. Silver at $74 could bounce hard or collapse to $55 within weeks. That's not a headline. That's the actual decision point sitting in front of this market right now. Here's what the price action is telling you, and more importantly, why it moved the way it did. Silver ran hard into resistance, then dropped fast. That speed is the detail most people skip over. Gradual declines suggest rotation, and fast declines suggest forced liquidation. When institutions need cash quickly, or when coordinated pressure hits a thin market, silver gets hit first because it's small enough to move and liquid enough to sell. What you watched happen recently wasn't random. It followed a pattern that shows up consistently when dollar strength is being manufactured, not discovered. Now you're sitting at $74. This is the zone below it. The next meaningful floor doesn't appear until around $55 a level. That represents genuine structural support built over years, not weeks. That gap between $74 and $55 is not a suggestion. It's a consequence with a trigger mechanism attached to it. For silver to reach $55, three things need to align. The dollar needs to rally decisively, not bounce, rally. The Fed needs to hold its posture longer than the market currently expects, and fear needs to turn from inflation fear into recession fear, which flips investor behavior completely. They dump everything real and run back into dollars and short duration instruments. That sequence has happened before. The conditions for it haven't fully closed yet. For silver to recover from here, a different sequence plays out. Inflation data has to reassert itself, rate cut expectations have to re-enter the conversation, even as rumors, not policy. Safe haven demand has to shift from bonds back into metals, and physical demand, the kind driven by industry and long-term accumulation rather than speculation, needs to absorb the selling pressure that paper markets keep generating. Physical buyers are already active at these levels. The question is whether their velocity is enough to offset what institutional liquidation can still deliver. This is where positioning logic separates the prepared from the reactive. If you're a conservative buyer, you wait. You want confirmation? A close above $74 with volume, or a defined base forming across multiple sessions before committing. Meaningful size, chasing a falling structure in silver when macro conditions remain unresolved is not conviction, it's impatience wearing the mask of strategy. If you're an aggressive buyer, you start small. Here, one committed if $74 holds and confirms over a defined window, and one reserved for a deeper breakdown if $55 becomes the test, one held entirely in reserve for the moment till clarity arrives. This isn't hesitation, it's architecture. You're building a position that survives multiple scenarios instead of betting on one. The most likely near-term path sits between the two extremes, a compression phase where silver ranges, tests both sides of current levels, and forces impatient hands out before directional commitment resumes. That kind of structure gives you something most participants forget to value: time. Time to observe, time to add with information rather than assumption. But the warning that matters most is this: do not concentrate your entire position at any single price level. Not here. Not at $55. Not at any point that feels like obvious certainty. Markets in uncertain macro environments are specifically designed to punish premature conviction. You can hold the correct long-term thesis and still absorb serious damage by forcing entry where patience was always the actual edge. The next 10 days carry the answer: dollar trajectory, Federal Reserve language, and physical market absorption rates will either confirm the structure holding or signal the next leg lower is already in motion. You don't need to call which outcome arrives first. You need a position built to respond to either one without requiring a rescue. Watch the signals and protect the structure. Let price confirm before size follows.